In the spring of 1602, in a narrow brick house on a canal in Amsterdam, a clerk opened a leather-bound ledger and wrote down a name. Beside it, a number. That number represented a share, a slice of ownership in a company that did not yet own a single ship's cargo and might never return one. The clerk sanded the ink dry. He had just recorded the first transaction in the history of the modern stock market. To understand why that moment mattered, we have to begin earlier, with the sea. For centuries, long-distance trade was a gamble measured in human lives. A merchant in Venice or Antwerp would load a ship with silver, send it toward the Spice Islands, and wait. 2 years, 3, sometimes forever. Storms, pirates, disease, and rot swallowed entire fleets. One voyage could make a family wealthy for generations. One voyage could destroy it entirely. The problem was not ambition. The problem was risk. No single merchant, however rich, could absorb the loss of a fleet. The solution was elegantly simple. Divide the risk. Instead of one man funding one ship, hundreds of people would each fund a fraction of many ships. If one vessel sank, no one was ruined. If the fleet returned laden with pepper and nutmeg, everyone shared the profit. In 1602, the Dutch government merged competing trading companies into a single enterprise, the Dutch East India Company. And it did something unprecedented. It sold shares to the public, to merchants, yes, but also to carpenters, widows, servants, and shopkeepers. Anyone with savings could own a piece of the voyage. More than 100 people bought in, but a share is only useful if you can sell it. And so, almost immediately, a second invention appeared alongside the first. On a bridge over the Amsterdam Canal, and later inside a purpose-built courtyard, buyers and sellers gathered to trade those paper claims among themselves. Prices rose, prices fell. Rumours of a returning fleet could move a fortune in an afternoon. This was the Amsterdam Stock Exchange, the world's first true stock market. Within a generation, traders there had invented short selling, options contracts, and speculative bubbles. Every mechanism of modern finance, including its capacity for madness, was present at the birth. The idea travelled west, across the North Sea, and found an unlikely home: the coffee house. In late 17th century London, coffee houses were the internet of their age. Smoky rooms where men read newspapers, argued politics, and traded information. One establishment, Jonathan's Coffee House in Change Alley, became the gathering place for stockbrokers, many of whom had been expelled from the Royal Exchange for being too loud and too disreputable. There, amid the clatter of cups, share prices were chalked on the walls. Deals were sealed by handshake. Out of that room grew the London Stock Exchange. Then came America. In 1792, New York was a city of fewer than 35,000 people, its streets still muddy, its harbour crowded with masts. On Wall Street, named for a defensive wall built by Dutch settlers, 24 brokers met beneath a Buttonwood tree. They signed an agreement of just 2 sentences. They would trade only with one another, and they would charge a fixed commission. That document is known as the Buttonwood Agreement. It became the New York Stock Exchange. For decades, that market moved at the speed of a horse. Then, in the 1860s, everything accelerated. The telegraph arrived, and with it, the stock ticker. A small glass-domed machine that printed prices onto a thin ribbon of paper, clicking out numbers in a continuous mechanical whisper. For the first time, a man in Chicago could know a New York price within minutes rather than days. Ticker tape spilled across office floors in white coils. Information had become a commodity, and speed had become an advantage. The market grew through railroads, through steel, through oil. And by the 1920s, it had grown into something intoxicating. America after the First World War was electric with confidence. Radios in living rooms, automobiles on new roads, and a belief, widely shared, that share prices could only rise. Ordinary people bought stocks on margin, putting down as little as 10% of the price and borrowing the rest. Shoeshine boys gave stock tips. Fortunes appeared on paper overnight. Then came October 1929. On the 24th, Black Thursday, prices collapsed. Crowds gathered outside the exchange on Wall Street, silent, staring upward. 5 days later, on Black Tuesday, more than 16 million shares changed hands in a single session of panic. The ticker ran hours behind, still printing prices from a market that had already ceased to exist. By 1932, the American market had lost nearly 90% of its value. What followed was not merely a financial event. Banks failed, savings evaporated, factories closed, farms blew away in dust. Unemployment reached 1 in 4 American workers. The Great Depression would last a decade and reshape the politics of the world. Out of that wreckage came rules. The Securities and Exchange Commission was created in 1934, requiring companies to tell the truth about their finances and making it a crime to manipulate prices. The market would remain risky, but it would no longer be lawless. Recovery took a generation. After the Second World War, a new American middle class emerged, and with it a new kind of investor. Not a speculator, but a saver. Pension funds, mutual funds. Millions of people who never set foot on Wall Street nonetheless owned a piece of it. Then in 1971, the physical market began to dissolve. Nasdaq opened with the world's first electronic stock exchange. There was no floor, no shouting, no Buttonwood tree, just a network of computer terminals quoting prices to one another. It was at first dismissed as a market for small, unproven companies. Within 30 years, those small, unproven companies were named Microsoft, Intel, and Apple. Screens replaced paper. Algorithms replaced brokers. Today, the majority of trades on major exchanges are executed not by people but by computer programs, some of them measuring opportunity in microseconds, millionths of a second. Firms have laid fiber optic cables through mountains and built microwave towers across continents to shave thousandths of a second from the journey of a price. And yet for all that machinery, the underlying idea has not changed since that clerk in Amsterdam dipped his pen. A stock market is a device for sharing risk. It allows strangers to pool their money behind an idea that no single one of them could finance alone. A fleet, a railroad, a vaccine, a rocket. It has funded extraordinary human achievement. It has also produced bubbles, panics, and ruin, roughly once a generation, with an almost tidal regularity. Because beneath the ticker tape and the fiber optic cable, the market remains what it has always been. A crowd guessing at the future. Sometimes wisely, sometimes not. More than 4 centuries after that first ledger entry, the ships have become companies and the canals have become cables. But the question every investor asks is still the one asked on an Amsterdam bridge in 1602. What is this worth? And what will it be worth tomorrow?